So, and the same with silver. So what it argues to us is that, okay, now we're about to enter, in fact, we've entered the phase where those parts of the monetary metals complex will lead gold. This has happened before. And usually when it happens, it's quite dramatic. In fact, if you go back and look at that bull market in 2001 to 2011, in 2010, silver went vertical while gold continued up, but silver exploded geometrically.
Right.
And we're at that phase now. In fact, if you even just look at a price chart of silver, any of your watchers, just go look on your quote screen and get a silver futures continuation chart, meaning it rotates to the next active contract. Okay. Go back to the 2022 low. Remember that low? That's when we paused from 2020, 2021, and it was flush in gold. It took it from like $2,000 down to $1,620. Well, silver also went down then, made a low. Miners, same story. If you plot the action since 2022 low, which would have been like August, September of that year, you could plot a parallel uptrend channel on price even. You've emerged through the top of that. Yeah, an upward bull market, but at a definable angle of recurring rallies and lows that just stay in the tube, and frustrate people because you get these sell-offs in the tube, but it's still rising. They forget to see that. We've blown through the top of that. We did that about a month ago, and after doing it, we've paused. But we're above the channel top and comfortably quiet. So we've had a breakout, even evident on price, much less momentum, which already broke out before that. So I think we're headed to, pardon me, my camera is moving. I think silver's has entered now that acceleration phase. Our expectation is this. It's not outlandish. The $50 highs we saw in 1980 and 2011 in silver. Think about how much time has passed. Well, the decay in the money, even since 2011, has been enormous. Yeah. So even just to get back to 50 isn't getting back to 50 in real dollar terms. We'd probably have to go to $200 silver just to match the 1980 peak, at $50. Okay.
Right.
I think we're going to go to $60 to $70. There was below the $50 highs out, what I call idiot highs, because they really don't mean too much, especially in real terms. And do that this year in this surge that we've now commenced.
This year?
This year, meaning in the next 5 months or so. There might be a pause there. I'm not sure, but I think at least we're going to blow out to 50 and not even pause till we're credibly beyond it. Now, is that the end? No. We're in a different situation now. I think you know it. Eric Sprott knows it. A lot of people know it. This isn't just another gold, silver bull market. This isn't just 1980 and then it's over and you go down to hell for the next couple of years, or 2011 and you go down to 2015. There are things going on out there that are far more disastrous, pending, and already commenced, that will impact monetary metals. We don't call them precious metals. Platinum's a precious metal. Gold is a monetary metal. So is silver. You started out the year, gold rose from January through April, surged upward and paused in mid-April. And what did the stock market do during the first part of the year through mid-April? Collapsed. So, the total opposites there. And then it rallied off the April low. Gold paused. You would think, well, if gold's opposite S&P, S&P went down hard, it went up hard, then therefore gold should go down when S&P goes up, right? Well, it didn't do it. Instead, it went to sleep, comatose for 4 months. That is not the way gold market ever tops. When it tops, it tops. You go back to 2011, the 2015 low, 1980 high. I mean, it's an isolated peak and you collapse. Okay. When you go to sleep in gold for 4 months, while the stock market is sucking its money back in, instead of it flowing into the alternative of gold, but instead there was demand for gold anyway. There were sellers all for that 4 months, and yet it wouldn't break. You get these sharp little drops and then boop, right back up again.
Yeah.
Stock market, we think, is making a major top. We think it began in January. The fact that you made new highs recently, marginal, by the way, we're talking 3-4% above the highs of last year or early this year. That as it tops, money flows elsewhere. It's never the case when money flows out of everything. You go back and look through history, big stock bear markets. No, everything didn't go down. Certain things went up. The two things that went up most obviously were T-bonds, up in price, down in yields, long-term T-bonds I'm talking, and gold related. This is the stock. The gold has already been underway for 10 years upside. It has major cycles, and what they're really dependent on is not some headline here or there or some market here or there, but on the overall onward decay in the money unit, the dollar.
Right.
I don't mean the dollar versus the euro or the yen. I'm talking about the dollar's real buying power. So when I was a kid, a loaf of bread was 20 cents. Okay, it's not anymore. Okay, it's because of the decay in the dollar, not because of increase in bread prices. The real value of the dollar, you lose, it increases in quantity. M2, for example, almost doubles every decade. Huge, almost doubles every decade. The population doesn't double every decade. But anyway, and now recently, the last 10, 15 years, it's gone up even more steeply. You look at an M2 chart from Federal Reserve and you'll see it. Well, right. So naturally, prices of things go up because the value of the dollar goes down in real buying terms. It takes more dollars. So people that cheer, for example, the stock markets, it's stock market, got to be there. It's always making money. Let's go back 25 years, throw a dart. July of 25 years ago, the July 2000, S&P's more than tripled since then at current price levels. More than tripled. Sounds good, huh? Gold's gone up 11-fold. Okay, 11-fold.
Right.
Okay.
Right.
Now, yeah, if you flint return, no, you didn't get the 11-fold gain, but it's gone up 11-fold with definable bear markets in between that we've defined. And right now we turned bullish on gold in February 2016, 2.5 months off the bear low, which was 1,050. Right now we're 3,400 area. Nothing since then in that 10-year period has altered our annual momentum trend analysis of gold. And that's what do we mean by that? It's when you measure gold monthly action, monthly bars, like a price chart, but we measure them versus a 3-year average or 36-month average. And we plot them as an oscillator, meaning, okay, this month's high, low, and close are how much above or how much below that changing average. And it ends up, you have an oscillator. It goes above the zero line, it goes below it in bear market, et cetera, et cetera. Nothing structurally in terms of defining the trend on momentum is even threatened right now in terms of breakage, downside breakage.
Mm-hmm. Okay.
We see all the evidence here that this pause in gold, 4 months now, total boredom, is about to launch again. And it probably will launch next month, my best guess. Now, look what's uniquely happened, though, in the last 4 months. While gold has gone sideways and yawning, not going down, but just sideways.
Yep.
Silver's gone up explosively. We've gone from the upper 20s to the upper 30s in that 4-month period. And if you look at GDX, for example, it's risen sharply as well, while gold stood still. So it used to be the other way around for the last several years. Since that 2020 upshot we had in gold, the miners and silver, it peaked basically in mid 2020. Gold had a range-bound situation, 20% to high-low, but silver and the miners tended to retreat more.
Right.
Were arduous. They get nice rallies, but it'd be a zigzag to the downside while gold went sideways. That is shifting. It's shifted in the last several months, especially since April, where the miners, if you plot them as a spread, meaning you divide the price of GDX into gold ounce, express it as a percentage, and plot that chart.
Yeah.
And you'll see that it's broken out over trend structures that are easily defined when you plot that spread, downtrends, horizontal lines, etc. And that is that when that shit hits the fan, pardon me, you have to edit that out. The
Stuff.
central banks will go more berserk than they have ever been. Because not only will stock market go down, but all the data points they like to chatter about, how, oh, job market's looking good, which it really isn't when you look at the inside data. But once the market starts down, if you go back and look at the 2000 top to the 2002 low, 2007 top, 2009, all the data points that they like to chatter about really started to go south in an obvious way once the stock market topped.
Yeah.
And started down. And finally, people started pulling their hair, and there were the CEO says to the don't hire any more employees this month. We're on pause or lay them off. And all of a sudden, the data points will shift. That's when the central banks will go ape. And they always do. They always do. If you go back and look at those two tops, you'll see they started cutting rates like crazy. It didn't help the stock market. What helped? Two markets went up during that time, gold and T-bonds. Question now is T-bonds. You mentioned that.
Yeah, please.
Yeah. Well, the T-bonds are they're not responding to the Fed. They usually don't, because it's the long end of the debt market. We're talking 30-year T-bond futures, okay, not the 90-day stuff. When the Fed cuts rates like they did, back late last year, a couple times, took it off the high, the recent high, shallow high, by the way, in terms of rates historically. T-bonds went down in price, up in yield, despite them cutting rates. And if you look at a T-bond futures chart or a yield chart, which is the opposite, of course, they're clustered. T-bond prices are just laying on the floor, anemic looking, despite even during that drop in April in the stock market. Didn't help the bond market. They tried to go up in price. There was a nice rally into early April, but then they collapsed. And they're just laying here a point or two off the floor of the last, actually, several years. So the long-term rates are choking, and they're not letting loose. The noose is not getting looser. It's just as tight as it was 2 years ago, which means there's a lot of big corporations, especially commercial real estate, and plus the government is hurting because of this. So we don't just have a mortgage problem like we did in 2007 to 9. Now suddenly it's government debt, not family mortgage. We all know that there's credit card excesses, by the consumer. They're at their limits. They're past due. We also know there's a lot of late filing of taxes now, increased sharply. People just can't pay it, so they delay or they try to set up a plan. Something's hurting already. But when it becomes bleeding obvious to the central banks, gold already knows this is going to happen. Mm-hmm. That's why it's not sitting and waiting for the bad data points for the Fed to cut. It's already on its way. It knows. And not just the U.S., but the Japanese have been doing it, and we know the EU will too. So that's the dynamite. So we watch the stock market because it's going to have an impact on the central banks, but also money flow. If people get out of the stock market, they go somewhere. And they usually go to those two things. But if you're a portfolio manager and you're looking at gold and T-bonds ain't working. Only gold's been working. Gold's up, despite the pause, is up a lot more than the stock market this year, the last 3 years, the last 10 years even. You go back to 2015, gold's beating, Anyway, I think it's just part of the fact. These things come and go, what you're talking about, where the Fed changes dramatically. Okay.
Yeah.
This one is the political realm to it. We know that it hasn't been true in the past so much as now. And, I just remind everybody who regards Trump as a free market advocate, you're not a free market advocate if you advocate the central bank, in other words, the monopoly control over the commodity of money, artificially prices money well below reality. Like he wants to go to 1%. Why not free? What the heck? Let's go back to free again. That's helped the stock market for 15 years go up. It's a bubble. You print money. Money's free. It goes up.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers. But physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming, young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation. Silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.